But is it healthy? Is it buy time? All those questions to our market master. Pramod Gubbi, Head of Equities of Ambit Capital, has joined us in our studio very pleasantly. Thank you very much, Pramod, for dropping in. Well, first up, I mean, at 11,400, are you opening the purse and putting in buy calls?
Not really. I think the issue has been valuation, and this rally has made it even more difficult to pick stocks at these levels. Yes, the earnings season has given hope that the earnings recovery is clearly underway, much better than what most people expected. But I think we're still far from drawing comfort on the valuation side, particularly given the sort of headwinds, macro headwinds we're heading to both globally and locally. We'd like a little more margin of safety before we turn positive, taking these earnings recovery into consideration.
Okay, Pramod, hi, welcome to Mumbai. What brings you here? Do you have any kind of meetings lined up, any corporates that you've met so far?
I've actually moved back to Bombay now, so I live in Mumbai now, yes.
Okay, that's good to know. Have things changed since the last time you were here in terms of either growth, demand, things on the ground?
No, things on the ground clearly, as far as growth and aggregate demand is concerned, is clearly picking up after the two sort of hits we saw in demonetization and GST. I think we have clearly recovered from that front, both in terms of the economic recovery and corporate profitability. But however, I think on the economy front, the other indicators heading into this sort of a political economy cycle are sort of rearing their head in terms of the deficits, both on the fiscal and the current account side. Also a reflection of the strong recovery in aggregate demand. And also inflation, which is perhaps will be talked about the most today, given the credit policy. So other than growth, I think all of the macroeconomic indicators are beginning to show some signs of worry.
Okay, well, Bajaj Auto numbers are here. That 30% looks mind-bogglingly good. But Sonia, I mean, is there a base effect? Is this, I'm still waiting for that big number.
It's actually in line with the estimates. The Nomura estimates that we had was 3.97. Yeah, it's absolutely in line. It's 4 lakh units. And it's in line with what Rajiv Bajaj had said. They'd said that this 4 lakh monthly run rate is what they're going to...
4 lakh is optically better than 397.
Yeah, yeah, I mean, it's a round figure. But, you know, I think the breakup should be interesting as well, because exports have been doing well. We know that. It's the domestic business, the growth there. I don't have the press release right now with me, but these numbers are largely in line, and they're good. I mean, just because they're in line, that doesn't take away from the fact that they're good. They're good numbers coming in. 4 lakh run rate is something that they promised and what they've maintained in this quarter.
There's something to say for consumption, isn't it? Yesterday we saw Dabur with big numbers. I mean, there will be all one-offs and GST and grammage increased because of GST rates falling and stuff like that. But it looks like consumption has improved.
Yeah, indeed. I mean, like I said,
the price is already reflected.
More than reflecting, I think. But having said that, I think that's one area where you'll see sustained recovery, both in terms of top-line growth and earnings, given the sort of agenda that the government has for the next 12 months ahead of the elections in terms of spending. That'll keep consumption quite buoyant, actually. So across both discretionary and staples, that's one area where you can see some sort of earnings predictability. Although valuations, like I said, you do feel that you need a bit more margin of safety. But if earning stability is what will underpin those valuations, this is one sector which shows that.
Okay, you know, I just wanted to talk about the domestic growth for Bajaj Auto. It's looking very good, actually. 2.37 lakh units is what they've clocked in this month, compares to 2.34 in the month of June, 2.24 in the month of May, and 2.29 in the month of April. That chart should come up for you, the domestic sales growth. And that's something I think the street will definitely like, the pickup that we're seeing in the domestic market, considering that there were fears that, you know, they're losing market share, etc. There is this so-called price war that Bajaj Auto has come up with just in some of its products like the CT100, etc. You think that strategy will work in the long run? And would you buy any of the two-wheelers now, considering that most of them are at 52-week lows?
No, I think the two-wheeler story is clearly moving towards premiumization as opposed to the executive segment, which drove the two-wheeler story during the noughties. And we've clearly moved from that penetration story towards more upgrading, towards a more higher lifestyle product, as seen in the performance of iShirt, or for that example, even Bajaj's premium end products, vis-a-vis Hero's underperformance, which is largely a commuter executive bike segment. And that story is likely to continue. Premium motorbikes and scooters will be the two-wheeler story. So the price war at the entry-level bikes is not particularly great. I don't think it'll lift volumes enough to compensate for the loss in realization and margins. So it's not great for those who are exposed to the executive segment, particularly Hero.
Okay, especially if Harley comes and attacks that segment.
The Harley is in the premium segment, and it's at least
No, they said 260, right?
250 to 500.
Yeah, I mean, that's the premium for India, right? So we don't have a 500cc plus segment, but that's at least 5-7 years away. And there's enough there, I think. Yes, iShares growth may not remain at the high 20s level. It could drop to 20%, but having said that, even if you compound at 20%, you see a decent return over a 5-7 period.
The most predictable question that everyone will be asking you: corporate lenders, SBI, ICICI, Axis, BOB, has the tide turned?
I think we're close to the bottom, if not past in some cases already. It is clearly a positive sign. Having said that, I think we still need to keep our eyes open in terms of further deterioration in some segments of the economy, particularly the stressed segments. We haven't seen a clear recovery there. But in terms of their balance sheet impact, I think we might be close to the bottom. The P&L might see further losses as the provisioning coverage increases and provisions are taken on the P&L, but that's something that the market will see through. So what's important is further slippages. I think in most cases we've seen slippages being better than what they were expected.
So how much in terms of overall market return would you expect over the next 12 to 18 months? I mean, the Nifty has already put on weight to the tune of about 7% this year so far. What do you think the average returns could look like?
I think mid-single digit is what I would expect, given that a lot of the recovery in the Nifty this year has been pulled by a handful of stocks, and expecting these very same stocks to continue that sort of a recovery would be a bit too much, because a lot of them are priced to perfection now. Unless and until we see a broader recovery in the economy, and that's a big call to make given that we are heading into the elections and there are global macro concerns. So unless and until we see some of the other stocks, particularly the corporate lenders you talked about, maybe certain other interest rate cycle sensitive sectors picking up the baton in terms of driving the market earlier. At least the index level, I don't see more than mid to high single-digit returns.
Is bonds the place to be then?
It is. I mean, clearly for the retail investors, you see a lot of fund houses offering very attractive products on a post-tax basis. If you hold on for 3 years, you get the indexation benefits and stuff. So at least from a retail investor's asset allocation, I think incrementally you would allocate more towards bonds than equities. The last 3-4 years, you had significant exposure to equities, and that needs to be pared down.
Okay. What about tech stocks? I know we've discussed this in the past, but would you put more money to work here?
Maybe not as much as you would have 12 months ago, but I think there's still more legs to the sector because the rally hasn't been that broad-based. There are a couple of stocks which are still lingering, perhaps. You've seen increases in order wins that will flow through to the P&L in the next few quarters, and that should help earnings growth. And the valuation gap that you've seen build up with them, particularly the likes of an Infi and HCL with TCS, that should narrow down. So that means that there is still money to be made in that sector.
Okay, all right, we'll leave it at that. Thank you so much for joining us and giving us your views.